Okay, good morning to you all. Great being here. I hope one day Beta will be also 60 billion or something like that. It will, promise you. I would like to start my presentation with a question. How many of you feel more fear, relatively of course, when you are flying versus when you are driving? In Russia, of course. You can raise your hand. Okay, I'm not asking for backing up my mortgage. Okay, so all the others are afraid more of driving than flying, just to understand. Driving? Wow. In Warsaw. Okay. I'm supposed to use another city. Okay, we'll get back to that later. Poland is one of the fastest growing economies in the region. Its GDP in terms of price purchasing power in the last 20 years more than doubled, already passing the CE countries, reaching closer and closer to the OECD average. And when we're looking for the future forecast for 2025, we see even a greater results, 3.5 on average. This is the assumption, 3 times more than the EU average. And all of that is based on strong fundamentals like strong consumptions, private consumptions, and investment. Unemployment rate is the lowest ever. Inflation is being gradually but surely constrained. I believe it will go down to the normal before the pandemic. Working force, Polish of course, is one of the most highly educational within the EU, and it's been the base of a well-performing, export-driven economy, highly diversified, both in terms of product, services, and also in terms of geographic. Of course, you are mainly centered within the European region, but as today's event, it's even an advantage. And if you are talking about recent events, I think, are even strengthening more the Polish economy because they've created potential new growth engines. Because of all of those events, the trade war, the mega, make Europe great again, the German plan of the 50 billion investing, the friendshoring, something that happened after the COVID when countries understood that they have to have friendly countries in the back of their yards to supply their needs. All of this will probably strengthen the Polish economy. And all of what I was saying is also well reflected within the financial assets of the Polish household, which is growing twice the pace of the GDP, and it's currently more than 2 trillion, and it will continue growing. All of that is based on your hard work. And the structure of the financial households bear huge opportunity for the Polish capital market, because currently you have around 60% of your money lying in deposits and saving bonds, twice than the average in the European countries. And once the interest rate will go down, and it will go down, you will see this amount of deposit flowing out of the banks, flowing out of the saving bond, entering, first of all, because you're Polish, to real estate, but some of it will also get into the financial market. And if we're talking about financial markets, you have one of the cheapest financial markets in the world. What you see here are the parameters of the price earning, price to book. You see that the Polish equities are cheaper than most of main indices in the world. Maybe today it's not 10, it's 12, but it's still very cheap. But from the other hand, your equities are among the highest dividend payers in the world. So it's like having an apartment, buying an apartment in the center of Warsaw with 30% discount, but getting the highest rent. Wouldn't you buy it? An answer? But because of all of that, all analysts are praising the Polish economy and the Polish capital market. It's a great market with high potential. You should invest in it. Another thing is that, I don't know if you know, but it's the best performing market year to date in terms of USD based compared to all other indices in the world. your small market, your neglected market, your not relevant market is one of the best performing markets all over the world. So you're probably saying to yourself, wow, we're supposed to be happy, yes? No, we don't not supposed to be happy. Because most of the activity on Warsaw Stock Exchange is actually conducted by foreign investors. And it's like that you, all of you here, and the guys that are outside of this building, you are busting your ass to create a great economy just like the Polish economy, and then you're letting the foreign investors to come to the market and buy cheap. And frankly, I don't understand it. As myself, I'm as a foreign investor as well. I'm also buying those cheap Polish equities because they are great. And when I'm speaking with asset managers, and when I'm speaking with bloggers, I'm getting different kind of an answer. Yes, but you know, we are only 0.000 something of MSCI world. Who cares? And there is, you know, there is the risk of invasion of Russia to Poland, 3,000 kilometers from here. And the Polish capital market is not performing. I wasn't convinced. And I remember, it reminded me a well-known research created by the behavioral researcher by the name of Paul Slovic. He's a professor from the University of Oregon. He is best known for his work about affect heuristic, which in simple, what is affect heuristic? Is a situation where our feelings about risk influence our decision. And he made a very famous research by the name of the feeling of risk, where he tried to assess how our feelings toward the risk affect our decision. And he took different types of questions for in the research. What is more riskier, flying or driving, using a nuclear plant or coal-based plant, eating chocolate? And what he found out that when we feel that something is more risky, we tend to give him more risk, regardless of the data. And if we can take, for example, the question that I asked you at the beginning, flying versus driving, you know, when there is an airplane crash, it's all day in the news, you know, big pictures in the newspaper, all the time TV news about it. And it makes us frightened. But you know what are the real data between flight accidents and car accidents? How many people do you think on average are dying because of flight accident every year? Not in Warsaw. Less than 300. How many worldwide in car accident? Almost 1 million. 300, 1 million, and regardless of what we saw at the beginning of the presentation in this room, most of the people are more afraid of flying. And then I said to myself, based on what I showed you before, maybe this is the problem with Polish investor. Maybe there were past experience about the Polish equity market that make them afraid of its performance, much more than the logical data. And one thing that Paul also found out is that in uncertainty environment, emotions override logic. So I started with the basic. And I said to myself, okay, let's compare the returns of Warsaw Stock Exchange with the worldwide indices. And I've made a comparison between the well-known S&P 500 index you saw from the previous lecture. It's a well-known, well-used ETF by institutional. And I've compared it to the well-known index of Warsaw Stock Exchange, which is the WIG40. And actually, I saw that picture. S&P 500 performed in the last 10 years more than 10% on average per year, while the WIG20 performed around 4%. So then I said to myself, oh, damn, it's really a Plaxi index, flat index. How do you say damn in Polish? Okay, damn. Damn, it's a flat. But then I remember, but WIG20 comprises for only 20 shares. And Warsaw Stock Exchange has an additional 500 great companies. So I made another comparison, this time with additional indices of Warsaw Stock Exchange, mWIG40 and SWIG80. And the picture is completely different. Here is where I see a well-performing index that is well-deserved for such growth growing and vivid economy as the Polish economy. Because those two indices are performing just like the S&P, around 10 to 11% per year, and there is a reason for that. The first one, they are much more diversified. WIG20, maybe it's comprised of the biggest shares in the market, but it's mostly banks. While mWIG40 and mWIG80 is much more diversified, much more reflecting the growth of the Polish economy. The second thing, most of the companies at mWIG40 and mWIG80 are privately held, while most of the companies at WIG20 are governmental held. And that's make a difference because sometimes the decision of the government are not in favor of the investors. Personally, I can tell you I love banks, but when a government holds the banks and when the government said specifically that some of our decisions will not be in favor of investors, so that's why maybe it's performed like that. And that's why maybe mWIG and SWIG perform so well. And the last thing, and this is a great slide prepared by our own Mateusz Mucha, it seems that most of the growth of the Polish economy is happening while those shares are being part of the small index and the mid-cap index. If any of them already reach this big WIG20 index, it's very hard for them to replicate the same success. So if I'm summing up all what I'm saying at this first point, Polish equity market do perform, and they perform great, but it's not in the WIG20, at least not at back testing. They perform great with the mid-cap and the small-cap indices. Now, the second question that I'm asking myself, okay, I showed to myself, maybe I showed to you guys, that Polish equities are performing and they are well-deserved to be invested, but what about the risk? So I decided to create a comparison between S&P and mWIG, and it's supposed to be with 2 slides, but okay, I will give you the answer. So as you can see, mWIG is not more risky than S&P. It's even a little bit less risky in terms of volatility. So it means not just it's well-performing, its risk is the same, and when you're looking at the same chart, but with an event-driven chart, okay, with all the crises that we had in the last 15 years, and probably will have them also in the next 15 years, you see that albeit we had a lot of crises, like the debt crisis, like the Korean War crisis, like the Russia invasions, like COVID crisis. Of course, there were drawdowns, but time after time after time, mWIG40 performed and came back and generated more than 10% per year, although there were big crises. So it means 2 things. First of all, it's a great index. It doesn't fade from any crisis. And if you see a crisis, it's probably a great time to start investing with mWIG40. So I show you 2 things. First of all, the return, and then the risk. And then I was thinking to myself, okay, you're probably thinking to yourself, you know what? S&P and mWIG40 are the same. They have the same returns, they have the same risks. In that matter, I prefer the S&P. It's much more liquid, much more well-known. It's even nice to say S&P 500, you know, it's a very great brand. But for those who think like that, I would like to say that if, for example, Warren Buffett was Polish, first of all, his name would probably be Wacław Buffettowicz, a farmer from Wuhu or something like that. And I believe that he will probably recommend you to invest 20 to 40% of your portfolios in mWIG40. And he will do it from good reason, because home bias is a phenomenon which is relevant for all the world. It's a global phenomenon. Every country in the world, the biggest investors and the smallest investors have their own home bias. You can see even the US, 80%, Germany, Sweden, you name it. Everyone are doing home bias. And there is a supporting reason for that. One of them, which is the most important, is it seems like investing in local market reduces volatility, reduce risk. Second is more tax and cost efficient. Okay, they've talked here about a tax issue on dividend payment, and I can tell you, if there are private investors here, in order to invest in foreign ETF, you need to make a transition from zloty to USD, or for zloty to yen or whatever, and then to invest in the ETF, and then to bring it back to zloty because you live in Poland and you don't live in Massachusetts or something like that. So all of that are great advantages for the home buyers, and I've also made a small comparison to see how it is performed within the Polish market. And I've combined mWIG40 and S&P 500, and the results are in front of you. The returns, because both of them eventually create the same returns, is 10%. But look about the risk. It's much lower. They are actually compensating each other. You remember that supporting reason, reducing volatility? And this is something all of you, both individual and institutional, need to remember. Beside all the difficulties that might have in the Warsaw Stock Exchange or whatever, the combination of local indices and foreign indices are eventually reducing risk. And you can just take the example from the beginning of the year. S&P 500 went down by 10%, while mWIG40 grew up by 23%. Okay, maybe it's an extreme example, but based on the data on the last 10 years, it's a true example. So if I'm summing up, 3 things. 1, you have great economy. You're working very hard, all of you working very hard to make it great. So you should enjoy from it. You should invest in it. Don't let only foreign investors to pick all those equity in such a cheap price. Second, at least based on past data, mWIG40 is a great investment tool to get an access to the Polish capital market. I'm not neglecting WIG20. I think it's a great solution as well, but not as a standalone. You need to start with mWIG40 and maybe a portion on WIG20 and continue from there. And last, diversification is making your portfolio better than just holding one S&P or MSCI or whatever. And if I have 2 more minutes, I would like to address our institutional investors. I don't know if they are still here or if they are hearing us. Institutional all over the world are a great fan of ETFs. And there are many reasons for that, but I would like to mention 2 reasons. The first one, they use it where they don't feel they have any relative advantage. Okay, so for example, when I want to invest in S&P 500, I will not put any analyst to analyze each and every company because it's an efficient market. I will use ETF. The same goes when I'm doing it on a small markets like S&P mWIG80 or niche market like India. This is one situation. The other situation where institutional uses ETFs is for liquidity management. Because institutional need to get in and out for the market, sometimes they need to do it very fast. And ETF are a great tool to manage that. So these are the 2 main reasons. And for that 2 reasons, mWIG40 is one of the best solutions institutional can find to get access to the local market. First reason are returns. What you see here is a comparison between mWIG40 to the known active result, which is the TFI on the same segment. And as you can see, regardless of the time frame, it's all the time in top quartile of return, which this is what us as investors want to have. We don't know if an active manager will well perform this year or the other year, but we see that the index time after time is all the time in the top quartile. It gives us ease of mind, it gives us confidence. But there is another thing for the institutional that ETF are doing. Because if the institutional will invest even a slight portion of their activity in ETF, they will not just enjoy the liquidity and the best performance. They will also enjoy from other things. Because every time institutional are buying, for example, beta mWIG40, we are immediately putting liquidity to the whole 40 shares on the mWIG40. And if it's SWIG80, to the whole 80 shares of the SWIG80. So it means that we are providing more and more liquidity to the number 59 shares and 60 shares, and we are making Russia Stock Exchange, instead of being WIG20 and all the rest, we are increasing the depth of Russia Stock Exchange. We are creating more possibility with those 500 shares. And I'm giving you here the example that we have. I'm coming from Israel, I didn't tell you that we have in the Tel Aviv Stock Exchange. In the last 20 years, the liquidity, because of ETFs, in the mid-cap sector, grew from 12% to 30%. It's a lot. And that's what's able, institutional, and asset manager to make their own active trading also in those shares. And last thing, I see that you're standing. Half a minute. And last thing, which is also very important, when the liquidity will go also to the mid-cap, you will see that more and more mid and small cap companies, which are more important for the Polish economy, would like to be listed on Warsaw Stock Exchange. And instead of having one żabka every year, you could have 10 potential CCC or Diagnostica, because they will have more liquidity in the small and mid cap indices. Thank you very much. It's yours.